Hey guys, so when you hear about margin trading, if you're like me, the first thought that comes to your mind is probably that it's full of degenerates like on crypto Twitter, on YouTube, going 100x long and just gambling really. But did you know that it can be a legit way to hedge your portfolio as well? And there are very specific cases in which this could be a very useful tool in your investor toolkit. So in this video, I'm going to touch on which cases that may be, show you a demonstration on Bityard exchange, which is a contracts trading exchange in Singapore. And I want to thank them for sponsoring this educational video as well. And also touch on some other methods for hedging that are possible, like futures, perpetual swaps, options, and so forth. So before I get started, I'm going to say that I'm going to leave timestamps down below for your viewing ease, and leave disclosures and links down in the description below, and a special offer in the pinned comment. So without further ado, let's dive right in. So here's an example scenario. I want to paint a picture for you where hedging makes sense. Let's say you have one BTC and you want to hold the same USD value for it. Let's say that it's currently at 10,000 USD and you want to hold that portfolio value, right? And you have most of your crypto in long-term cold storage, which is a good idea after we saw the recent hack with KuCoin, for example. But let's say we're in a long-term downtrend, like in 2018, and you look at the charts and you think that it's going to break support levels soon and drop a lot further. So in that case, what you can do is send a small amount, let's say 10% or maybe even 5%, of your Bitcoin to an exchange that offers margin trading like Bityard, for example, or just deposit USD in that exchange as well that matches what that percentage would be, like the USD value of 10% of your Bitcoin holdings, for example. And then you can open a short position with leverage so that it matches the total amount of Bitcoin that you have. Then if the price drops, you get more BTC, and that allows you to maintain your starting USD balance. On the other hand, if the price rises all of a sudden and you lose your balance eventually, you'd get liquidated or called, but your BTC also goes up in price, so it maintains the USD value, right? And if it's a real breakout, then you can ride it and continue to gain more in USD value that way. Or if you want to continue to maintain the USD price of the increase, then you can open a new short at that time in a similar manner as I just described. Of course, with this strategy, you do need to closely monitor your position and close out your position at some point if you think it hit a bottom per se. Now, one easy way to better wrap this example around your head is to test it out with real numbers. So right now, I'm going to show you an online calculator, which makes it easy to show you some real numbers with this scenario. Okay, so let's just say, for example, we have one Bitcoin that we're trying to hedge, and we think the price is going to fall, so we're going to short here. We want to spend 0.1 or 1/10 of our one Bitcoin to do the hedging with, leaving 0.9 in a cold wallet, for example. And so just for the sake of example, let's say the entry price is 10,000 per Bitcoin. And this calculator is going to show us how the numbers play out. Here is quantity of contracts to buy, and here is the leverage. So for some exchanges, each contract is $1, and this may seem like a lot, 19,000 USD, but that does not mean it's the amount of crypto or USD you need to have on that exchange to open up such a position. Because as seen in this formula, initial margin, this is the amount you need to have on the exchange, is quantity of contracts divided by order price times leverage. So if you take our quantity, 19,000 divided by entry price, 10,000 times leverage, 19x. 0.1 BTC or 1/10 of our one Bitcoin balance, like I said earlier, right? So that's all we need to deposit on the exchange to open such a position using that formula. Exit price, if the price drops to 9,000, then using this calculator, we can see our profit and loss of 0.2111. Okay, so what that gives us is 0.2111 plus 0.9, which we still have on the cold wallet, times the new price per Bitcoin. And this gives us essentially 10,000 USD, which is what we started off with if you remember what the price was earlier. So this is an example of how you can hedge in this manner, and you can play with your own leverage, which decides how much initial margin or deposit you need to make, and you can play with the quantity of the contracts just to see how that affects this. But essentially, this third row, the profit and loss number, is important, and the rest are percentages and your entry position value, exit position value of what you're trading with. Since remember, with leverage, what that gives you is that you can trade as if you had a bigger stack than what you actually do on the exchange, right? That's how that works. And now moving to Bityard. This is the interface that I've shown you in a few different videos I've made so far. Since Bitcoin is currently at around 10,733, I'm going to put my initial margin at 1,073, which gets us around 1 Bitcoin's worth of total leverage stack with 10x leverage. And then you can click overnight to keep this position open. You will have to pay some fees though. Take profit ratio, stop loss ratio. Let me put this at 90% to let it run. And then sell. Boom, there it is. And that's pretty simple. I'll also link other Bityard tutorials and reviews and deep dives that I've made in the past to this video, but I just wanted to show you on a contracts trading exchange how you can use those concepts I just showed you earlier within the calculator and within the earlier part of this video. Now, moving on to some other methods for hedging. One is diversification, and you should be doing this anyways, right? Like not only crypto, but stocks, other financial instruments, real estate, and so forth. Those are great ways to diversify your overall investment portfolio. But that doesn't really work if you're only confining yourself to crypto, right? Because there's a lot of analysis that's shown that most assets are correlated anyway. So even if you split up between Bitcoin and a ton of altcoins, they roughly follow each other for the most part. And so you really need to find uncorrelated assets for this to work. Another method though within the crypto space is futures. And essentially, I'm going to paraphrase this from Investopedia, but they're financial contracts that obligate the buyer to purchase an asset or seller to sell an asset like a physical commodity, or in our case, Bitcoin or crypto, at a predetermined future date and price. And there's two types, right? There's cash settled in USD versus settled in BTC. But essentially, they both have the same effect for hedging purposes. Let's get an example, right? Let's say Bitcoin is currently at 10,000 and that's your entry price. And you enter a futures contract, long 1 BTC futures contract. And then at the expiry date of that futures contract, Bitcoin is at 11,000 USD, right? So your profit and loss, you take 11,000 minus the 10,000 because you entered at the price of 10,000. So that's what it needs to be delivered to you. And then you could sell it immediately at 11,000 for a $1,000 profit. And so that could go both ways essentially, but you can use it as a way of locking in your price. And a lot of miners actually use futures contracts to lock in their Bitcoin price so that they can pay their electricity and operational costs without succumbing to too much volatility. Futures is a great way to hedge as well because it's cheaper than margin trading, no daily funding fee in the case of futures, but it's not offered for most coins out there, only for certain big ones. And you also have to deal with other risks that I won't go into in this video, like basis risk and so forth. Another way to hedge is with options, and if you're on Robinhood lately, you know how to do this, like call options, put options, but this is not really widely offered in the crypto space as of yet, and implementing various strategies can be very complex and costly to do so as well. Some other cons for this approach is a higher premium, very illiquid, it may be hard to close out your options contracts, and also a lot of times it's just BTC only. So it's not really recommended. I recommend you looking at the margin trading possibility on exchanges like Bityard or futures contracts if you want to figure that out as well. So what are my final thoughts for this? This is a really interesting way if you have your coins on cold storage and don't want to transfer them back and forth to like sell into USD, for example. then this could be an easy way to hedge your portfolio and help it maintain your USD balance in like a longer term downtrend, for example. And that could be a useful tool for you to reach your investment goals. Like always, let me know what you think down in the comments below, and sign up for Bityard using my link. Once again, thank you guys so much for watching. Thank you Bityard for sponsoring this educational video. Be responsible, try these things out first, hedging while getting your feet wet before you use it full stop and go all out. This is Kevin. I hope you have an amazing rest of your day, and I'll catch you guys next time.